InFi, Episode 3.
Welcome to InFi, the Future of Finance, hosted by American economist and author Dr. Robert Murphy. Each week, tune in for dynamic discussions with business pioneers about emerging trends in finance, life insurance, asset management, technology, and more. Now, let's talk the future of finance.
Hey everybody, welcome back to another episode of InFi. Today we're going to be speaking with Chris Kirkpatrick, who is the founder of Life 180 and is a recovering producer of indexed universal life insurance products. And that's a big part of what we're going to talk about on the episode today. Chris is now a very big proponent of using whole life insurance for his catchphrase is cash flow hacking, ways to increase your wealth much more safely and conservatively than what they tell you to do on Wall Street. And so that's where Chris is coming from. And he's a bit provocative. He likes to mix it up with people online. He has a very big YouTube following. If you go and look up Life 180, so that's the word life and then 180, you'll find his channel. It's quite popular. And he tries to take other gurus representing their points of view on head-to-head. He has a standing debate challenge to them that we'll explain in the episode. But beyond all that big picture, I wanted to have Chris on because what he's trying to do is clarify the arguments, even from people that he agrees with ultimately. Okay, so even people who also use the particular product that he thinks is appropriate in this space, Chris wants to make sure that the way we communicate that to the public is accurate, and that's my goal as well. And so that informs the later part of our discussion. So without further ado, here is my conversation with Chris Kirkpatrick. Chris, welcome to the InFi podcast.
Hey, thanks for having me. It's awesome being here.
So I would have already given a little bit of a background in the pre-recorded introduction, but just for our listeners, can you give a quick background as to where you're coming from and how you got into this space?
Oh, yeah, man. So my funny story, I'll try to make it really quick. I got into this space. Before I got into the life insurance space, I was actually a professional poker player. And so it was around the Great Recession, like 2009. When I first got into the financial industry, I actually originally got in thinking I wanted to join like a wirehouse brokerage, like a Wells Fargo Advisors, Merrill Lynch, something of that nature. And my father-in-law had been working for 35 years with Wells Fargo, Wachovia, those companies. And I was going to be a succession plan. And so I went in to interview and his manager was like, Chris, I think you're going to do really well, but like, I don't know if you've looked around, but the economy's not exactly doing awesome. And you haven't had a job in 7 years. So if I hire you, they're going to fire me. And like, that's not going to happen. So I was like, well, what do I do? And he's like, well, go get a job at an insurance company. They'll hire anybody. And I was like, no, I'll go do that and I'll prove myself. So the funny part is I got into this business thinking it was just going to be the springboard for me to go and get in the investment side. And then quickly realized that I just fell in love with the messaging behind insurance and what it can do for people. And philosophically, completely turned my belief set around on all the other investment stuff. And the funny part was when I first got into the business, I was really big into the index universal life space. So I joined one of the top IUL companies in the country and quickly kind of rose through the ranks, got rookie of the year, sold a lot of policies, had a lot of success, became a manager, became the director of business development for the company and had a lot of success. And so it was really awkward going to my father-in-law being like, hey, by the way, I know I joined this space as a springboard to come join you and be your succession plan, but I believe in it so much. And only 4.5, 5 years later to go back to him and be like, oh, by the way, I'm leaving that job because I don't believe in it anymore. And I realized like I was wrong about IUL and it's not the golden goose. It's not all these things. And he's like, oh, so you're going to come join me? I'm like, no, not things haven't changed that much. I'm still going the whole life insurance route because that I've realized is actually the product and the solution that's in alignment with my values and beliefs and what I'm trying to, do to educate people to take more control of their finances. And so, it's been a big evolution since that point in time, but that was how I got into the business. And then when I left that company in 2014, I launched Life 180. Since that time, Life 180 has taken a bunch of different iterations on kind of like what we do. But it's grown into becoming an insurance agency. And we recruit agents, train agents, help people. I help agents with marketing and knowing how to sell, learning how to sell, because, I mean, let's face it, you and I know, like, the communication around, like, the role whole life insurance should play in your life is wildly misrepresented in a lot of situations. And it's also, for a lot of people, it's really hard to dial that story in and be effective at communicating the power. That's kind of what I love to do.
Okay, well, great. So a lot there that I want to unpack.
Yeah.
But one thing you mentioned sort of as a throwaway line is that you originally were a professional poker player.
Yeah.
So if we'll permit me, because I think a lot of the listeners are like, well, that's way more interesting than life insurance. And
Probably,
that's true for most things.
Yep.
Talking about photosynthesis maybe would be even. So let me just ask you, because I've interviewed someone where I'm going with this, you'll see, is
Okay.
I think it was the movie Rounders with Matt Damon.
Yep.
We know where he's playing the professional poker player. And there's a line in there, and because I was talking to another professional poker player, interviewing him for something else that he was into, the libertarian stuff that I'm into.
Nice.
And I quoted this line to him from this movie, and he said, "Yeah, I don't even know what that means. That's stupid." And the line, I might not have it exactly, but it's something like they say, sometimes you have to fold with a winning hand in order to be able to later win with a losing hand. And he was saying that made no sense to him. How do you, do you think there's a modicum of truth in that, or is that nonsense? Is there no reason you would ever intentionally fold with a winning hand?
Well, so I think what he means in that is not that you obviously are never going to fold if you know you're winning. But I think in any poker scenario, any poker hand, it's very rare that you have the absolute best hand in the scenario, right? Like, so most of the time you are kind of playing odds, right? Like, so typically when you put your money in, the best you're going to hope for is being about an 80% chance to win,
Mm-hmm.
And that's kind of like where people call it gambling. And whereas if you have an 80% chance to win every time and you consistently get your money in the pot with those odds, you're going to make a lot of money, right? And so I think what he's saying in that is, like, if you're not 100% sure and you're in a spot where maybe the bet is so big, and if you don't have the best, there's a chance they have the best. And even if you are right, there's still a chance that they could get lucky and win. And if there's still cards to come. And so it's just understanding pot odds, it's understanding variance, it's understanding bankroll management and cash flow management, because I think that's the part about playing poker professionally that translated into this whole concept of investing for cash flow is, I think what made me really, really amazing at playing poker was the systems that I played, but part of that system was a concept of bankroll management, right? Like, in having rules in place, because every tournament I would enter, if anybody's not familiar with poker, I mean, there's what we call asymmetric returns in poker tournaments, right? Like, I'll buy into a poker tournament. I may not cash for a tournament 20 times in a row, but when I actually win a tournament, I'll probably get paid 100 to 200 times what the entry fee is, right? Like, so it's, you don't have to win a lot. You just have to be consistent and manage the variance in the process. And so when we start talking about, like, everything we do with utilizing whole life insurance as a foundational asset and investing for cash flow and having, like, an opportunity fund and knowing where to take risks and when to take risks and what your risk profile is and kind of what it all looks like. I mean, I think that's probably how poker prepared me most for all this.
Well, you very diplomatically transitioned and said a bunch of true statements, because I think the statement's nonsense. All right, we'll drop. Don't worry, I'll move on to talk about life insurance. But
okay,
because I think what they're trying to, because even there, you're kind of explaining why you might sometimes fold with a hand that you think could probably win, but you're not sure. But that still wouldn't explain how does that then make you better able to win later on with an inferior hand. Because I think what the script writer, like, I doubt a professional poker player gave them that line. I think what they were trying to imbue was to say, you build up credibility. Like, if you fold and let them win with a crappier hand, like, it makes them think you're not a bluffer. So then later when you do bluff, it has more credibility. I think that's probably the angle they were taking. But I would also say, like, if it's against the same player, but then there are also spots where you just got to realize, like, sometimes, like, I'll be sitting at a table with 10 players, right? Me and 9 other guys, right? Playing a cash game or playing a tournament or whatever. A lot of times, if you're playing in poker, like, I played in the main event at the World Series of Poker this year. I played 7 events at the World Series, cashed in 3 of them. You know, it was a fun time. But, like, whenever I'm playing, like, in the main event, there was one guy at the table that I was like,
I'm just not going to mix it up with him. Like I've got 8 other players at the table that I know I can abuse and that I know I can like play different angles. And there's one guy who's at my level that I'm like, I'm just like, why tangle up with him if I don't need to? So if we ever got into a spot, it would be worth folding, even if I thought maybe I was good, even if I thought I had the best hand, just to get into a spot to abuse a different player at the table.
Okay.
That might be a scenario.
All right. Maybe they did. Okay. I see what you're saying. That is more nuanced.
You know what I'm going?
I'll give you that. I'll give you that. All right, I like that. All right, good. All right. But I got to ask one more. So when you talk like that, when saying like you're seeing another player and you're realizing, oh yeah, I don't like, for example, like as an economist, I understand what you mean is there's people out there that I could beat them in an argument even if I didn't believe what I was saying. Like, whereas there are other people that I would be afraid to debate.
Yeah.
Like I wouldn't risk, like there's this one guy, he's a market monetarist. And I always say, I wouldn't debate him next week. I would need 3 months to get ready because even though I think he's wrong, I know he's solid and, like if I debated him next week, he would beat me, even though I think he's wrong. So when it comes to poker, when you talk like that, what is it about is it like a whole suite of capabilities? Like, yeah, they're good at calculating really fast, but also they don't have any obvious facial tics when they, when they hit their trips. And what is it like all of that put together?
Yeah, it's kind of a combination. It's an amalgamation of a lot of that, but it's more, I think, more of like a playing style. You understand there are some people that are just very by the book, ABC, exactly what they hold. And some people are much more creative, much more willing to take risks. They play a much more open range of hands, like whereas some of the people at the table, that they're going to play aces, kings, queens, ace, king, just the premium of premium hands. And so like against those guys, I'm going to open up against, right? Because I know I can outplay them. Even if I'm not good, I can bet because they're going to be more tentative, more scared. Whereas other players are going to fire back and play back at me and maybe re-raise me. And you just got to kind of get the feel of, what type of player they are and what kind of angle and lines they're going to take when they're playing. And, the goal is it's a concept called pop control. We want to control the environment that we're playing, right? And when I'm playing against an inferior player that I know is playing straight up kind of ABC poker, I can control the pot even with an inferior hand, knowing the range that he's on, and then bluff or make a move or whatever later, knowing that unless he got really lucky or really hit it hard, he's going to be really tentative and probably fold, right? And another player, that's just not the case, where it's harder to control the pot in the environment in which I'm playing in, because I could bet thinking I'm in control, but then if he re-raises me, I've lost control of the pot control, right? Like now a pot can start to build and I'm putting a higher percentage of my chips in the pot that I'm willing or wanting to risk for that stage of the tournament. And so there's so many, we could talk about all that for hours.
Okay, well, we should stop in deference to the listeners who thought we were going to be talking about the financial sector. Although we could just basically say, quit your job and become a professional poker player. And, there you go. Might be true for some people. It probably is true for some people. All right. So let's focus a little bit then on, so yes, obviously here at Infineo, a lot of what we do involves the tailoring of whole life insurance policies. And I know, I'm aware of some of the dangers of using IULs, and there's all these horror stories, and the press is doing hit pieces on people that are suing companies because they had, I don't know if they're variable ULs or IULs that didn't perform the way they were projected. So maybe can we start from scratch and just explain to people, like, what is the difference between a whole life and a universal life, and then why is it that you came to believe, even though you were originally a true believer, you were Rookie of the Year, and then what was it that made you start having second thoughts about this particular product?
Yeah, I think the challenge with Index Universal Life is that from a foundational asset perspective, it is something we have to take a look at kind of before even getting into the product. We have to be thinking about, why do I want this asset in the first place? And I would say that that's the truth for whole life insurance as well, right? Like, you don't just want to put your money into anything without really understanding what problem are you trying to solve with this asset, right? And so I think that's the biggest problem with IUL, is that there's a discorrelation with what the asset actually does versus the problems that you're trying to solve, right? And so first and foremost, when you put your money into an IUL policy, you're giving control of all your money to the insurance company. And if you look historically speaking, traditional universal life products have done nothing but fail. And all index universal life is a traditional universal life product with an options strategy attached to it. And so they basically take the fixed crediting that you would get in like a dividend for a whole life or a fixed crediting and a UL. And they basically say, all right, instead of crediting you that, we're going to go buy options with it. And maybe we'll get lucky, maybe we won't, right? But that's really all it is. And so when all these agents are out there saying you have upside potential because you're participating in the market, like the S&P 500, you're never invested in the S&P 500. You're using a fixed crediting strategy that instead of taking, that as a payment, you're allowing the insurance company to take that fixed crediting amount to create an options budget with that amount and to go buy call options on the S&P 500. So as soon as you do that, what do? You inject a ton more risk and variables into an asset that is supposed to be lock solid, guaranteed, to be there. And now you're taking risks and you're getting involved probably in things that you don't really understand, that you probably couldn't explain, that you don't understand all the variables that are coming into play. I'm really big on, this concept I call cash flow hacking, which is basically utilizing whole life insurance by cash flowing real estate and leveraging whole life as a foundational asset to do so. So just kind of using that as an example, because I'm a big believer in utilizing life insurance like that. The reason I don't like index universal life in that situation is because the reason I'm using whole life is because I want it to be predictable. I want it to be stable. I want it to be controllable. I don't want a lot of moving parts in that asset that's fulfilling the need of getting the money for like the down payments and all the things on the real estate that I want. I don't want extra variables and risk outside of the risk and the variables that I'm already taking with the asset and real estate that I'm acquiring, right? As soon as I use IUL in that instance, I'm now injecting more risks, more variables, more unknowns. Now, on top of all the risks and everything I have in my real estate investment, now I have all these unknowns and risks inside of the life insurance contract. That's the problem. Now, fundamentally speaking, technically, IUL is just basically, it's an annual renewable term product that you can never pay up, that will always have costs, that the costs get bigger and bigger and bigger, higher and higher every single year. The insurance company has the ability to manipulate and maneuver and control fees to their benefit and against yours. And one of the big reasons that I stopped selling, that I started realizing IUL was not something that was in alignment with my values and beliefs, and certainly wasn't in alignment with what I was selling to clients, was when I talked to an actuary and he said, Chris, the number one reason life insurance companies are flocking to the IUL market is because of control. All the products that they have with guarantees, they're like, and this was back in 2014, remember, right? Like when I went through this, but they said they're anticipating this long, low rate interest rate environment. And we saw the updates with the 7702 changes and all the stress on the general funds of the general accounts of these whole life companies. We saw that kind of play out in 2018, 2019, 2020 with a 7702 update. And at that time, he said, listen, there is stress. Like, it's hard for these companies to meet their guarantees, and there's a lot of uncertainty for these companies, and they have to manage their risk as a company. So they're launching and putting more effort into marketing IUL because it shifts the risk from the insurance company onto the insured, right? And so from a philosophical perspective, that's totally out of alignment with why I think most people feel like they're putting their money into a life insurance contract.
Okay, great. And so just to disentangle two things, so just the basic UL chassis, even if it's not IUL, just plain vanilla UL, what that essentially is, it's like you say, annual term that just, you have a renewal option indefinitely, but they have the contractual right that they can, like the pure cost of the insurance that they're charging you to keep the death benefit coverage in force for another year, that effectively goes up over time, and that's being reflected as a charge.
Right, because as you get older, the annual renewable cost gets older or gets more expensive, right? It's kind of like if you have a 20-year term policy, most people don't realize, but at the end of that 20 years, it doesn't mean the term goes away. It just typically means that term gets so expensive because it becomes annual renewable. And by the the age you are, as you get older, when you're buying term insurance, which is big amounts of money, like say 500K to $1 million, and you're 75 years old needing to buy $1 million of life insurance, that's an annual renewable term, you're going to be paying a lot of money annually for that. And what happens is that winds up crushing the cash value and the efficiency inside the policy. And I will say this is, a lot of people say that IUL is like a cheaper whole life. And I will say it's cheaper for the first 15, 20 years if you're buying it when you're young because the insurance is cheaper. But if you're buying IUL, typically you're buying it because, in the way that it's sold, most people are buying it for retirement income, right? I mean, it's the whole tax-free retirement game that's been played that a lot of people like buy into. But the bottom line is, as soon as you start using it for retirement income, that's when the wheels come off of it. That's when it starts to like break down, and you see all the holes in the concept and the strategy, and the math just doesn't work. And so all these people talking about how it's this like amazing solution. Well, I'm going to tell you, like, IUL is just a failing financial experiment, period. UL failed, and it started in 1980. By the 90s and early 2000s, I mean, all you have to do is go look and see how companies handled all the lapsing policies for ULs that were poorly handled. And then 1997, IUL was created, but it didn't have any market share until 2009. And from 2009 to today, they've been performing worse and worse and worse and worse. And we don't have like this track record that shows like, hey, at the way we're selling it for tax-free retirement income, you know, so when you buy it when you're 30, 40 years from now, when you're 70, this is how it's going to work. They don't know how it's going to work. These illustrations don't mean anything. And the product hasn't even been around for 30 years yet. So nobody knows what it's all going to look like. But what we do know is how it has actually performed, what the internal moving parts of the policies have performed as and been set as and been manipulated and changed to over the past 15 years has gotten worse and worse and worse and worse every year. So I don't see it getting any better. And so in a sense, I would say IUL has been bailed out by the greatest bull run of all time that we've had in the S&P 500. So that's the only reason that they looked even halfway decent at this point in time, where they haven't been completely exposed yet. But I think over the next 3 to 5 years, we're going to see IUL, you know, the tide's going to go out and the IUL's wearing no pants. That's what I'll say.
Right. Okay.
To use a Warren Buffett analogy.
So let me repeat this back to you. So, I mean, obviously, the fact that the mortality rate goes up as a person ages, that's true regardless of the product.
Totally.
But with a whole life policy, in a sense, the company is giving you the guarantees and just giving you the fixed premium, whether it's paid up at 65 or, you know, you pay through the L121 or whatever. But so the insurance company is effectively taking the risk. They're saying, look, we'll just pay you. You just make this annual premium payment. And then our actuaries are telling us with that number, you budget for that. And then we will make sure we can make your death benefit claim. And so it's like the insurance company has already built all those future increases in mortality expenses into the calculation, which is why, as you're saying, in the early years, it can look like, wow, I'm paying a lot for my whole life policy. My brother down the street is paying a lot less for the same death benefit coverage, but that's because he's, in a sense, taking a risk that, you know, on the future performance, where you're sort of, it's all, you know exactly what you're getting into and paying it, and then it's up to the insurance company to deliver. So that's the sense in which they're taking the risk with a whole life policy.
Totally. I mean, at the end of the day, you and I could tell everybody there's no free lunch in this insurance game, right? Like everything is actuarially driven. So if it looks too good to be true, it's probably too good to be true, right? Like that just is what it is. And when I look at it, just like taking a step back and getting outside of like, all right, what does the illustration look like? How much insurance do I have? Or, you know, whatever. We always have to think long-term. And when I take a step back and I go, all right, from a long-term perspective, do I want to put my money with a participating mutually held life insurance company and basically be a business partner with them, like a shareholder? And like, you know, that's equivalent to what it is. So do I want to do that? Therefore, as the business is more successful, I'll be more successful as long as I handle my end of the arrangement in the bargain and pay my premiums. Or do I want to do an IUL and be a profit center for the business, right? Like, so I have the choice to be a business partner that shares in the success and the profit of some of the most successful long-term financial companies on the face of the earth, if not the most successful, or I can turn around and be a profit center for said company. that will support the people that have these policies. Like to me, when you look at it like that, it becomes kind of a no-brainer. You know what I mean? But like people just
definitely. And then let me just fill in one loose end because what you said, it's interesting because I've encountered a lot of people when they see how the IULs project and or have illustration, and they don't even understand like how could it be that you're telling me like if the S&P 500 goes up 10 percentage points, the cash portion of mine gets credited 8, but if the S&P crashes, my thing doesn't go down. How can that be? But the explanation is because what they're not actually buying into the market, they're just buying call options. So if the market goes down, the call options expire worthless. And if it goes up, they benefit from the upside. But because there's the cost of buying the option, that's why it's not a 1-for-1 typically.
Exactly.
So that's what they're doing behind, that's under the hood what they're doing. But and I guess probably
correct.
They needed to do that because the regular UL, like you say, wasn't performing well in the long term. So to make it look like it might, they would slap on like to pay back it to the stock market. And so if you said, and the market historically grows 9% a year. And so if we just robotically assume it goes up 9% every year for the next 30 years with no downs, then look at this is way better than a whole life. Like that's the trick they're doing. But in reality, obviously the market doesn't just keep marching upward.
Well, the worst part about it, Bob, is when you look at an IUL illustration, it's assuming positive years every single year, right? And so that's the challenge with IUL is that you and I both know that's never going to happen, right? Like, I would say if you believe that the market's going to go up every single year, we're not going to have a down year, then go buy an IUL. It'll work for you. But the reality is that's not going to happen. And when you look at an illustration, it's showing positive 50 basis points of arbitrage, meaning positive. You could borrow money against that policy and it's going to grow. You're going to be credited 50 basis points, 0.5% more than your borrowing cost. So when you look at it in a vacuum and on an illustration, that works 100% of the time. It looks really sexy. And if it worked that way, I got news for you. I would do it. You would do it. Everybody in the world should go out and do it. If it actually functioned that way, it would be magic, but it doesn't work that way. So what happens with IUL is, and this is one of the things they always say, you can't lose money due to market loss. Have you ever heard that phrase in an IUL? Right, you can't lose money due to market loss. But here's the deal. In retirement, because how are we taking income? We're taking it through loans, right? So if you start taking loans for retirement income at 60 years old, and by the time you're 70, you've taken $100,000 a year of loans out against this. And let's say you're paying 5%, that's $1 million of income you've taken, but you probably owe like 1.4 million in like total loans because the interest expense is compounding. On the illustration, no big deal because you're earning positive 50 basis points of arbitrage. But in reality, 35 to 40% of the time, the policy, the actual real life scenario is the credits are going to be worse than the cost of than the cost of the loan. The market's going to perform at less than the 5% of the loan rate, right? And so when that happens, instead of having the positive arbitrage, you actually have an added expense, and that added expense will end up compounding and creating more costs inside of the policy, which as you get older becomes more and more catastrophic. That's why these things blow up in people's faces. That's what I always kind of tell people. If you're buying a product to solve a problem in retirement for retirement income, tax-free income, why are we spending so much time focusing on what it's going to do for you in the first 10 years, first 15 years? Let's focus on like what it's going to be doing at the time you're going to need it to solve the problem you're trying to solve. You know what I mean? And like nobody wants to have that conversation. And I've challenged, David McKnight, Doug Andrew, all of the biggest IUL producer, influencer, educator people. I've challenged every single one to a debate. And they all ghost me because they know that they can't back their story.
Okay, well, if any of those gentlemen hear this episode, I extend, you can come here. It'll be a fair forum. I'll keep the blows above the belt, as they say. And
there you go.
If we want to have a discussion of views, certainly we're always welcome to such things here at InFi. Okay, well, I think you've not been hiding your views about the IUL product, but I'm also aware that even among friends, among the community that teaches people the living benefits of how to manage cash flows with even just whole life policies. Yeah, there are, and I've done some of this in my work as well, where people perhaps earnestly, but are teaching things in ways that aren't quite right, or like maybe what they're saying, the conclusion's correct, but when they say why that's true, it doesn't, the analogy's goofy, or they just say something that's not right to get to what still is a good product for the customer. So I don't know,
Yeah.
do you want to go through any, again, you don't need to name names perhaps, but just give some examples of the kind of thing that you see a lot in this space, just for our listeners to let them know, hey, be careful that some of the stuff out there is not quite right.
That's amazing. So I'll say this. The reason I love whole life insurance is because of the fact that no matter how you buy whole life insurance, right? I could sell somebody an IUL, for instance, and I could design it and structure it the perfect way, and that policy could still lapse. It could blow up in my face because of the internal workings of the policy. That's why I don't like IUL. The great news about whole life insurance is that I could sell Bob a whole life policy, and I could design it perfectly for him, and he's going to be ecstatic. If I sold him a poorly designed policy, the only thing Bob needs to do to fix it is just stay consistent to the plan, and basically time will solve all problems because of the way dividends are credited, and eventually it's going to work out. Would you agree with that?
Yeah, I think so. That's why I could sleep at night with, people getting put whole life policies, like you say. As long as they can make the premium payments, it's okay.
Totally. And so from that perspective, that's great. And so the good news is like, even the people, and I said that to kind of preface this, because even some of the agents out there and the influencers that are talking about it in ways that I don't necessarily agree with, the reason I don't want to call them out specifically or like hammer them personally is like, because I think they're still doing better work than 99% of financial advisors out there. That's just kind of my belief, right? So that said, though, like there are a couple concepts that I think are really important. I created this concept called cash flow hacking because I try to go away from a lot of the marketing terms that people are using because they're just getting misrepresented. The whole infinite banking concept and like the idea of whatever you want to call it. Like that's just kind of like the term, and I think the one that's used the most by people. But the idea of having an asset that is a foundational asset, I kind of look at it like this. It's a foundational asset that you can kind of like filter all of your decision making through, right? And then from there, we have to make the decision, is it a smart place to put my money, or is it not an ideal place to be making an investment to go and try to accomplish my goals? And is what I'm trying to do in alignment with my goals and what I'm trying to accomplish in life and my objectives? And so when we look at that, one of the things that I see a lot is a lot of people online trying to convince people that they can make money buying depreciating assets, right? Mm-hmm. So it's like, Bob, put your money here and I'm going to show you how you can make every dollar back for your car. You pay $50,000 for your car. I'm going to show you how you can make $75,000 when you buy that $50,000 car. And it's a bit semantics, right? Like, and it is what it is. But here's what I'm going to say is that you're not making the $75,000, for instance, in this situation because you bought the car, right? Right. Mm-hmm. I would say this: if you're going to go, and let me preface it. The reason I think this is dangerous is because if I convinced you, Bob, that you could go out and buy this $50,000 car, but you're going to make $75,000 back on it. Well, maybe you're in a situation where, had you not had that mindset, you probably could only afford a $30,000 or something of that nature. Now you're taking and doing something that you probably wouldn't do. That's probably not the most efficient or effective way for you to be handling your finances, right? Whereas if I said, hey, Bob, no matter what, if you have to buy a car, like find the car that you want to buy that is in alignment with your lifestyle, with that the car that if you had cash in your pocket, or if you were going to go to a bank and get a finance, one or the other, like what is that car? Policy aside. And you said, I'm going to buy this car. And then I would say, all right, let me show you a more efficient way to buy that car. And then we can go through all the different options and education on that. Well, now we can have the conversation about the efficiency of buying a car and doing something you're going to do anyways, versus like trying to convince you you're going to make money buying a depreciating asset. Because the idea of making money buying depreciating assets is just malarkey. A lot of people are talking about it online. And really what they're trying to say is like, hey, you can buy with your whole life policy. The policy is going to be compounding all at the same time, rather than pay the bank your money or give up control of the cash, right? Because there's an opportunity cost when we pay cash. Rather than do that, put your money through a whole life policy, pay for it through there, recapitalize your policy, pay back the policy. And by the end, you're done paying it off. You're going to make, let's say the account value for this analogy is $75,000. So they're going to say, hey, you're going to have paid for it. You put the money back in your policy and, you'll have made all that money. And it's just not necessarily, yes, that's how it works. I'm using bigger numbers. I don't know if it'd be quite 75,000 in that instance or whatever, but the idea, first of all, you wouldn't be making 75, in this iteration, it would be 25,000 extra, right? And they'd be saying you'd be getting the car for free because all that money's back and capitalized and you'd have liquidity and, access to that money. But the bottom line, like for me, the way I look at it is I can take that 50,000 and go buy a cash flowing asset, buy an appreciating asset like real estate or a business or something of that nature. And to me, that's what I love this about. I think when we start talking about buying depreciating assets and leveraging it, it can be done. And it is absolutely a more efficient way to handle your dollars if you're going to go, do these, buy cars or something of that nature. But I think what I love about it the most is that it's just a set of rules, and it's a system that you can, and it's a discipline, it's a habit, it's a way of saving and kind of creating rules that keep you out of trouble, quite frankly. It's what I would call safe leverage, right? Like you go borrow from a bank, you're giving up control. If the economy goes sideways, if anything happens, the bank can repo your car, you have to miss a payment, get credit banged up, all that stuff. When you do it this way, you're in complete control. And that's where I kind of think, taking over the banking function kind of comes in, is
right.
That element of control. But the idea that you're making money on depreciating assets, I think is just not true. The other one I hate, and I'd be curious to hear your take and go back and forth on this.
Well, if I can start, let me just respond, because I want to amplify what we said. So one thing, just to avoid me getting a bunch of hate mail. So I am from people who use the phrase infinite banking concepts. I knew Nelson Nash, so certainly I like a lot of them, but you're right. There are a lot of people who, particularly ones who were not involved with the people that I was directly involved with, who embrace that term and then say a bunch of stuff. And it is definitely problematic that the people saying stuff like, oh yeah, this is exactly what those people are talking about. It's infinite banking. And it's some nutty things, like, as you say. I hit that myself, Chris, in some of the training I was giving where, like you say, people say, oh, let me show you how to get rich buying cars. And you're right, there's a twofold problem. That was in the thing. That's what I showed. I said, okay, in terms of the cash flow, it's certainly not buying the car that causes because what they're doing is like, they'll have two different scenarios of person A and person B. And person A is doing whole life financing with policy loans, and person B is, using the auto financer or their whatever, leasing or whatever. And person A ends up with a higher net worth. And I'm saying, okay, but notice the buying the car is the same in both. It's the finance. I said, if they bought a bank CD that was rolling over at 3%, their net worth would be much higher still. So clearly it's not the buying the car that's doing it. And that'd be like, saying, here, I'll show you how to eat pizza and lose weight. And then if someone's like, whoa, tell me how. And you show that, 6 days a week, you have this very rigorous diet where, very limited portions, low carb, whatever, you're going to the gym. And then every 7th day is a cheat day, eat whatever you want. Yep. And you can eat pizza, and that's fine. Mm-hmm. And that would be misleading to tell people, I'm going to show you how to eat pizza and lose weight. Even though technically,
absolutely. That's a great analogy.
It's not like totally a lie, but it's very misleading. And like you say, if that's how you're selling it, probably people aren't going to stick to it as much as if you say, let me show you how to, have this rigorous diet for 6 days a week that does have a cheat day.
Not just that, I would say, you've seen this a lot probably as well, but the one thing I will say is that the biggest challenge with whole life insurance, or where people get into trouble with them, as much as I love them, as much as I love the concept and the philosophy and utilizing whole life insurance, it's human behavior that screws it up. And it's bad management of loans and bad understanding about how loans actually work. And so what happens is a lot of these people, like, if let's say I got you a policy, Bob, and I said, hey, you can get rich buying cars, right? Like using the analogy and sticking to this concept. 10 years from now, if you say, all right, I'm going to capitalize this policy, and in year 12, I'm going to go buy a car and I'm going to take a loan against this policy I'm going to get that car. I'm going to do all this stuff. You're going to be in a much better position to do so. And the policy is going to be a much more powerful role in that transaction, right? But if I sell you a policy and I teach you this concept and you buy into the fact that you can get rich buying cars, and then I tell you, you can have access to your money within 30 days to go buy your first car. And then you go buy that car and you don't manage the loans properly because you think you're getting positive arbitrage and all these things that are being talked about, you're screwed. That mismanagement, misbehavior because of a lack of understanding of how it actually works is going to be your downfall. So it's not the product's fault though, it's the human behavior fault. And it's a lack of education and understanding. And because there's so many half-truths being tossed around online about this stuff, it's causing confusion. And that leads to negative consequence for a lot of people.
Yeah, I've seen, I saw one too. I can't remember like the label they were giving it, but they were trying to convince me that, if you, how'd it work? It's like if you deposit money in a bank and in the savings account and is earning 4%, but then you need money and you borrow from the bank at 6%, you're still better off. Like intuitively, you might think you're losing the 2 points, but you're not. And the way they like prove it is because over time, if you pay down the loan, that like you're still earning more on the base of the 1,000. Like if you only took a $200 loan or something, and so over the lifetime, when you're knocking out the loan on the side that's rolling over at 6%, you pay less total interest in the total. But it's still wrong. Like I would show them with a spreadsheet and say, no, that's not right. Like just because you end up with more money at the end, you would have ended up with even more still if you had just withdrawn the 200 or whatever the thing was and stopped earning 4 on it rather than paying 6 because you are losing 2. Like, so in other words, I'm saying like they would use things where the math wasn't wrong in terms of the person starts out here and ends up here, but they would say some stuff in the middle about what was causing that outcome that was not correct, and like trying to, like they would deliberately try to shock you because most people would think, why would I lend at 4 and borrow back at 6? It seems like I'm down 2 points. And you are. But they would do that to then try to show why. So don't worry what the policy loan interest rate is. It's completely irrelevant. And so that's
it does matter.
One.
That's
what I'm saying. Of course it matters. It doesn't mean it doesn't mean the underlying strategy is wrong if the policy rate goes up, but it just means explain for the right reasons why you still think it's not just, it doesn't matter how much you're borrowing against because you're still making more. Like, no.
I will say with that analogy though, one of the elements that I do like about that though, let's just say somebody went out and bought cryptocurrency, right? Like they were like, they bought into the fad and I love cryptocurrency, right? Like, and some people, it's not that I don't think everybody should have some. It's just like, are you ready to take the risk that comes with cryptocurrency? Are you set up from a structural perspective to take the risk and the swings of crypto? You know what I mean? And like, if you need to be liquid, I would argue you probably shouldn't have it in crypto. Like if you need that money to like live on and be liquid, but a lot of people did that. A lot of people speculated and went and put 100 grand or whatever into crypto. I would argue like, if I was going to put money into crypto, I'd rather take a loan against my policy, put it into crypto, because if that underlying asset that I invested in crashes, I have the ability to like not just have lost that money, I can systematically rebuild inside of the whole life policy by managing that loan and recapitalizing the policy while never have interrupted that growth, right? And my human life value is insured the whole time, right? Like, which we cannot, like, I feel like a lot of people that focus on the cash value element, the banking side of policies, they really downplay or even completely negate. And they say, I don't even care about the life insurance. Like when to me, that human life value part of it is huge, right? Like the fact that we have I love investing for cash flow, right? So the fact that we have the ability to basically buy our net worth. A lot of people, and let me start this. A lot of people will say, oh, whole life is great if you're already wealthy, right? It's a wealthy person's product, right? Like I would argue it's like it works for them and the wealthy people understand the values of it and they understand it because they're more sophisticated. So that's why they do it. But I would argue for middle class, it's even more important because as a middle class person, chances are you don't have your whole human life value worth of money stuck in an account. So if something happened to you tomorrow, your family would be screwed, right? Like, or not be able to live the life you wanted to live. So you can buy your net worth and then focus on investing for cash flow as to actualize it over a period of time. There's no other asset in the world that can do that for you. And that's why I love it.
Right. Yeah. So yes, I like that. And I'm endorsing too what you said a minute ago. So I'm okay. So folks, we'll try to link to this. So again, this is InFi episode 3. If you want to look this up, we'll put in the show notes. But yeah, I recently did a thing, Chris, on the uninterrupted compounding. And there I was just making the point. I said, I'm okay with, some person A's got 100,000 in cash surrender value in a whole life policy, and person B just has it like in a savings account, and they got to make a $20,000 purchase, and just look at the pros and cons. And so, yeah, I think it is significant to say person A, when they take out a $20,000 policy loan, every year they can look at their statement, and that loan is just looking at them and saying, this is the consequences of your previous. If you could just pay me down, then you'd have, you know what I mean? So I think the psychological element there makes the person more frugal probably, whereas person B, who just took it out of the savings account, that money's gone. They don't see the shadow of that, the ram of, they're just, but even there though, but just to be clear, like it's a psychological thing. It's not, if the cash flows were the same, in other words, nothing's stopping person B from putting in the same amount that person A does. It's just probably, when you see the loan sitting there, it's more of a target, and it might make you, more likely to be frugal to knock that thing out. So I definitely agree, for human beings in the real world, this strategy is well designed to really encourage frugality, and why you probably end up with a higher net worth down the road. But the reason is for this kind of stuff you and I are saying, not because it makes sense to lend at 4 and borrow right back at 6 from somebody. Like, no, that per se doesn't make sense.
Well, and so let's talk about that for a second, of why that happened though. Because if you think about it, one of the reasons that I think this has happened is because the idea of positive arbitrage, and this is something I'm really passionate about. Like the idea of positive arbitrage in a whole life policy with a non-direct recognition company is absolutely possible, right? Like it's not, I'm not sitting here saying, and I want to make this really clear, that I'm not sitting here talking to you saying it's not possible, because it is. It's just not the principle in why you're doing this, right? Like, and that is an extremely important part. And I think what's happened is, maybe some people aren't as nerdy as you and I are about like really dissecting this stuff. And, they haven't been doing this long enough, because I know a lot of these influencers are online talking about this, and they're going, and they're only like, hey, I've been doing this for 6 years, someone would say, and this is what I know, this is what I've seen. But the bottom line is, we've been living in this decreasing interest rate environment. And if you understand rates and dividends and all these things, like I know you do, and you're working with a non-direct recognition company, as dividends or as interest rates are going down, dividends chase rates down. As interest rates start going up, dividends chase rates up. There's always a lag, right? And so we're now in this point where we hit a crossover where interest rates are going up and dividend rates are now lower with these non-direct recognition companies than the cost of borrowing. A lot of these people that have been in been in the industry for less than a decade, and they've never seen that. I mean, from 1980 to today, I mean, rates have been doing nothing but going down or being flat. And like, it's been kind of like a beautiful scenario. But even then, even in that environment where positive arbitrage in the environment made it possible, the principle of it is you still have to capitalize a policy. And I'd love to hear your take actually on that, because that is a big thing. The idea of like positive arbitrage, yes, I love it. You can do it. But there is that capitalization phase that has to happen in the policy before it becomes efficient enough to actually achieve that internal rate of return on an annual basis high enough to achieve that positive arbitrage, right?
Right. So I think if I'm tracking what you're saying, that there's policies and ones that I've recently looked at the illustrations for, that if it's a healthy person or whatever, the internal rate of return, including premium payments and dividend rollovers and things on the non-guaranteed side, it can it breaks 4%. And when you can take into account tax considerations, that's nothing to sneeze at, especially given how safe it is that once it achieves a floor, it can't go down, and you have access to it, via policy loans and such. That's a great type of asset to hold. But even there, like you're saying, you got to have the thing, those only are hitting like 9-10 years into the policy at the earliest.
Right.
And so it's not that you can just set that thing up and then, if you needed to you're financing some purchases for your business, you couldn't just start this thing on a dime and then be having it not only finance the purchases, but you're gaining every year a little few basis points and making money on the side, that's not going to happen right away.
And I do that a lot for real estate, right? Like, so we get a lot of people that do big front loads in and then annual premiums. And the goal is to try to pull as much possible out for real estate transactions as quickly as possible, right? As much as they can, as quickly as they can. Let's say like 45 days later, they want to buy a real estate property, with it. The trick there is you got to get that real estate investor to see like, all right, this is a long-term strategy. There is going to be a capital crunch at the beginning. Like if you put in 500 grand and like 400 of that is upfront, like single PUA rider, and then the rest is like 100,000, say 50-50 blend or something like that. You're looking at 450 is going in PUAs and 50,000 base. Now we're talking like out of that, you're going to have like a net cash value of maybe 440, 450. And then out of that, you're going to have liquidity of 90%. So you're talking 400,000. So you're going to lose 20% liquidity out of the gate. I would argue it's worth it. When you look from a long-term perspective, when you like work on it all and it's part of your system moving forward. But if you were to just take that one transaction in isolation, we could have a conversation as whether the capital crunch is worth it or not,
Yeah, it's funny you're just saying, because this is literally the stuff 2 weeks ago we were doing with a business owner, and it was exactly that. I mean, the numbers were different, but same principle.
Yeah.
And that's exactly what we did. And to be fair, so what we're showing is you're going to have to kick in more out of pocket in year one because of the fact that, it's not fully available to borrow. And so to do the apples to apples, we were saying, contrast it with what you're doing now, using like Ford financing, for these vehicles, and just showing like you putting in that cash, that out of pocket into some other vehicle earning 3% after tax or something, just to, and it was in early years, the net worth was higher in the conventional approach, but then I think it was like year 9 in this particular example, it crossed over where counting everything, you still had more cash. And then like you say, but the trump card was all along, the person had like $2.5 million of extra death benefit. And then that just kept growing. And so to say, that's not negligible. Again, you're not going to probably die next Thursday, but over the next 20 years, you could die. And in which case, this strategy gives you an extra at least $2.5 million that grows over time, that passes income tax free to your named beneficiary. So that's a great little perk to have here, and we shouldn't neglect that.
We shouldn't. I mean, as much as I like to rail on IUL, and I sold a lot of IUL my first 4 years, but talking right now about the human life value element of it in the life insurance side. That's the one thing IUL and whole life has in common. Out of all the policies I sold for IUL the first 4 years in the business, one of them is still on the books. I transitioned all of them, except for by the time I went and I realized what I realized, I went to transition one of them and the guy had gotten cancer. And it was a monster policy. Like for me back then, it was actually my largest policy at the time that I had ever sold. And because of the fact that he got cancer, he was no longer insurable, I promise you, he didn't care as much about the human life, like about the cash value. He cared more about his human life value at that point in time. And the fact that this thing had a $9 million death benefit with it is what he cared a lot more about than having the liquidity and access to the cash and doing all this stuff. Right. And so we just kept that in place. And, he ended up passing on a couple of years after, but his family got the $9 million, So like, that's the one thing I'd say, like IUL whole life, and like it's the human life value is not something to, because our health is not guaranteed. Tomorrow's not guaranteed. Like I call this a self-completing plan. It makes sure what you want to happen will happen when you want it to happen, whether you're here to see it or not, period. Like no other asset in the world to do it for you, only whole life insurance.
Yeah, exactly. It is. Just the more I study it, it's interesting. And I like reading people from different angles. I did some consulting work for this guy, Mark Spitznagel. He had worked with Nassim Taleb, and he's a hedge fund manager, and he's into Austrian economics. It's just how he and I, got to know each other. I was just consulting with him on that element. And his latest book having to do with safe assets to have, in case there's a storm sort of thing, safe harbor assets. And in there, he's got a little thing about how insurance is like perfectly designed for that. Like that's exactly the kind of thing where when there's a financial hit, this asset, boom, like performs, you know what I mean? Like in terms of, I want to have some gold in case there's inflation or what, like you're trying to hedge yourself. But insurance is like the ultimate hedge for a particular circumstance, like by design, like that's what it is. So it's really interesting in that regard.
Yeah, I mean, life insurance companies, I think, weather those storms so well because they, by nature, have to think super long term, right? Like that is what they do. And I always kind of tell people you can't solve short term or long term problems with short term thinking, right?
Mm-hmm.
You have to think long term. And, it's like the business owner you were talking about, some of the real estate investors that I deal with that maybe have that short term crunch, but our job is to give them the vision to see what it looks like from a long term perspective. And a lot of people are self-destructive in the sense they're only looking at the next 12 months, but it's kind of like taxes. We talk about taxes and 401ks, like qualified plans. Do you want to put your money in taxes right now or in a qualified account where you're deferring taxes when I think taxes are going to go nowhere but up? It's like, it may save you money this year, but if I could save you 10 grand this year, but it's going to cost you 40 grand later, is that something you want to do? Most people will say no, but that's what we're talking about with, why looking at this, it's the same concept, just in a different light,
Yeah, exactly. So I think that's probably a good note to end on here. We're hitting up the time here, Chris. For people who want to see more about your ruminations and analysis, should they go to your YouTube channel? Do you want to point them to where they should be going?
Yeah. So if you go to Life 180, just like on my shirt here, it's at Life 180 on YouTube. I'm on Instagram at Real Chris Kirkpatrick, on TikTok at Real Chris Kirkpatrick, all over the place. I create content like this all the time, and I love it. I think my favorite part is educating agents on this stuff because there's such a lack of good, unbiased kind of education on how it all works. It's not driven by the carriers or somebody that's trying to charge them to be part of something or something of that nature. Like just getting good information and kind of sharing my journey and what I've learned, so people don't have to go through all the headaches and heartaches that I went through to get to where I am.
Well, yeah, exactly. And that's certainly something that I'm passionate about as well, is trying to educate practitioners and also the general public about how these policies can be used both at households and business level. And I want to reiterate for those IUL champions out there, if you ever do want to go toe-to-toe with Chris, we'd be happy to host a debate or a friendly exchange of ideas. We don't need to call it a debate here at InFi. So, Chris, thank you for your time and everything you've been doing.
Thanks, Bob. Appreciate being with you guys. It was a lot of fun.
And thank you, everyone, for tuning in, and we'll see you next time.
This concludes another episode of InFi, The Future of Finance, with Dr. Robert Murphy. The information provided is for educational purposes and does not constitute financial advice. Consult with qualified professionals before making any financial or investment decisions. For more information on the host and for previous episodes, visit infi, thefutureoffinance.io. Thanks for listening.